that letter. If you haven't received one yet, you probably know someone who has. And if you're watching this video, you already sense that something is wrong, that the stability you thought you owned is no longer quite as stable as it used to be. Here's the thing, nobody tells you about owning a home in America. You don't actually own it the way you think you do. You own the equity, you own the title, but your ability to keep it depends entirely on a system that most people never think about until it fails them. It's called the insurance market. And in 2026, the insurance market is failing, not slowly, not gradually, fast, quietly, and with consequences that will reshape American homeownership for a generation. Today, we are going to walk through exactly how this happened, why a war in the Persian Gulf is directly connected to that non-renewal notice, and what it means for your net worth, your mortgage, and the value of the single largest asset most American families will ever own. By the end of this video, you will never look at your homeowner's policy the same way again. I want to start with a number. Before the Iran conflict escalated in February 2026, the U.S. homeowners insurance market was already under significant stress, primarily from climate-related losses, wildfires in California, hurricanes in Florida and along the Gulf Coast, flooding events that the models didn't predict at the frequency they were occurring. Major insurers had already pulled back from certain high-risk markets. State Farm stopped writing new homeowners policies in California in 2023. Farmers Insurance limited its exposure in Florida. These were warning signs. Most people missed them. Then February 28th happened, and the stress that was already building inside the insurance industry didn't just increase, it transformed. What had been a manageable, if difficult, set of climate-related actuarial problems became something entirely different, an open-ended, unquantifiable geopolitical risk that no mathematical model on Earth can price with confidence. The uninsurability crisis of 2026 is not primarily about hurricanes or wildfires anymore. It is about something insurers have never had to calculate at scale before, the domestic consequences of state-sponsored cyber warfare. And to understand why that is so devastating to the insurance industry, and to you, we need to spend a moment understanding how insurance actually works, because most people don't know, and the details matter enormously here. Insurance is, at its core, a risk-pooling business. The company collects premiums from thousands of policyholders, invests that capital, and uses the returns plus reserves to pay claims. The business model works when losses are predictable and distributed, when the company can look at historical data, build a model and say with reasonable confidence, in any given year, this percentage of our policyholders will make a claim of approximately this size. The law of large numbers is their best friend. Predictability is everything. What state-sponsored cyber warfare does to that model is catastrophic. It introduces the possibility of correlated loss events, situations where thousands or tens of thousands of properties in a single region suffer damage simultaneously, not from a natural disaster with historical precedent, but from a deliberate, intelligent, adaptive adversary that is actively trying to maximize damage. The insurance industry has a name for risks like this. They are called uninsurable, and that word, when applied to your zip code, is the single most dangerous word in the American real estate vocabulary. Let me take you inside the mind of an actuary for a moment, because this is where the crisis actually originates, before it ever reaches your mailbox. An actuary's job is to put a number on risk. Every risk. If you ask an actuary to price hurricane coverage for a home in Tampa, Florida, they have 100 years of historical data to work with. They know the frequency of major storms. They know the average damage per event. They know how building materials affect outcomes and how proximity to the coast affects exposure. They can produce a premium that reflects reality with high confidence. That's the business. That's how it works. Now ask that same actuary to price the risk that a foreign government will conduct a coordinated cyber attack on the power grid, serving the metropolitan area where the Tampa home is located, causing widespread infrastructure failure, pipe bursts from loss of heating, fire suppression failures, and secondary structural damage across tens of thousands of properties simultaneously. Ask them to produce a probability estimate, a loss projection, a premium. They cannot do it, not because they aren't skilled, because the data does not exist. There is no historical precedent for a successful large-scale state-sponsored cyber attack on U.S. civilian infrastructure causing mass residential property damage. The first time it happens will also be the first data point, and you cannot build a pricing model on one data point. What you can do, what actuaries across the industry are doing right now, is look at the threat intelligence. Look at the 800% increase in probing attacks on U.S. water and power infrastructure since February 28th. And conclude that the probability of a catastrophic correlated loss event has risen from theoretical to plausible, from plausible to credible. And when a risk becomes credible and unquantifiable at the same time, the rational response for an insurance company is not to raise the price. It is to exit the market. This is not a theory. In the 6 weeks following the Iran strikes, 3 major regional insurers announced they were suspending new homeowners policy issuance in zip codes classified as critical infrastructure adjacent, meaning within a defined radius of power generation facilities, water treatment plants, communications hubs, and military installations. One national carrier quietly added language to its renewal notices that expanded the existing war exclusion clause to explicitly include infrastructure damage resulting from acts of foreign cyber warfare overnight. The legal definition of what your policy covers changed without a news conference, without congressional action, without anyone asking your permission. I want you to do something after this video ends. Go find your homeowner's insurance policy. It's either in a physical file somewhere or in your email. Find it, search for the words war exclusion or hostile act, or acts of foreign enemies. Every standard homeowner's policy in America has some version of this language. It has been there for decades. And for decades it was essentially irrelevant, because no foreign government was conducting operations that could plausibly damage your specific house in Ohio or Georgia or Nevada. 2026 changed that. And the change happened through a legal mechanism that is elegant in its simplicity and devastating in its consequences. The war exclusion clause has always existed in tension with the efficient proximate cause doctrine, a legal principle that says an insurer is liable for a loss if the primary, dominant cause of that loss is a covered peril, even if a non-covered peril contributed. For example, if a fire starts in your home because of an electrical fault, and the fire department can't respond quickly because of a natural disaster blocking roads, your insurer still pays. The efficient proximate cause, the fire, was covered. This doctrine has historically protected policyholders from insurers using minor non-covered contributing factors to deny legitimate claims. What the insurance industry's legal teams have been building since February 2026 is a new interpretive framework that argues cyber attacks on infrastructure constitute a primary, not contributing, because of any resulting property damage. If Iran-linked malware shuts down a power grid, and the resulting loss of heating causes your pipes to freeze and burst, causing $60,000 in water damage, the insurer's new position is that the efficient proximate cause of your loss was a hostile act of cyber warfare. War exclusion, claim denied. This has not yet been tested in the Supreme Court. It may not hold up when it gets there, but here is the brutal practical reality. Insurance litigation takes years. Your mortgage payment does not wait years. Your damaged home does not wait years. When your claim is denied and the legal battle begins, you are living in a damaged, potentially uninsurable property, while making mortgage payments on it, with no certainty of when or whether you will see $1 of compensation. And the people who are most exposed to this trap are not the wealthy. The wealthy have lawyers and the financial cushion to sustain a multi-year legal fight. The people most exposed are the people who bought a house with 5% down and a 30-year mortgage, whose entire financial safety net is the equity in that home, and whose assumption was that if something catastrophic happened, their insurance policy would be there. Let me walk you through the mechanics of the worst-case scenario, not to frighten you, but because understanding the mechanism is the only way to interrupt it. This is the insurance to foreclosure pipeline, and it is already operating in parts of this country right now. Step 1. Your insurer sends a notice of non-renewal. Your policy expires in 30 to 60 days. They are no longer willing to cover your property. The reasons may be stated or unstated. In many states, insurers are not legally required to provide specific reasons for non-renewal. Step 2. You go looking for a replacement policy. Depending on where you live, you may find one at a significantly higher premium, or you may find that the major carriers in your market have all retreated from your zip code. You may be referred to your state's fair plan, the insurer of last resort that state governments maintain for exactly this situation. Fair plans exist in every state. They are also, almost universally, more expensive than private market insurance and provide less comprehensive coverage. Step 3. If you cannot find replacement coverage within the window your mortgage servicer requires, typically 30 days from notice of lapse, your lender activates a provision that exists in virtually every mortgage contract in America. They purchase what is called force-placed insurance on your behalf. Force-placed insurance is not purchased for your benefit. It is purchased to protect the lender's collateral interest in the property. It covers the structure, minimally, against catastrophic loss. It does not cover your personal property. It does not cover liability. And it costs, on average, 4 to 8 times what a standard homeowner's policy costs. Step 4. That force-placed premium is added to your escrow account and distributed across your monthly mortgage payment. For a home where the standard insurance ran $1,800 a year, force-placed insurance might run $9,000 to $12,000 a year. That is an additional $600 to $850 per month added to your housing cost without your consent, without your choice, and without any meaningful benefit to you beyond the bare legal minimum required to keep your loan from being called. Step 5. For a family already stretched by war-driven inflation, $7 gasoline, $350 grocery bills, elevated utility costs. An additional $700 a month is not a budgetary inconvenience. It is the difference between staying current on the mortgage and missing payments. And missing mortgage payments triggers its own cascade. Late fees, credit score damage, acceleration clauses, and ultimately foreclosure proceedings. The war with Iran did not need to drop a single bomb on American soil to trigger residential foreclosures across the country. It needed only to create enough geopolitical uncertainty to make the actuarial models fail, causing insurers to exit, causing lenders to force place, causing monthly payments to spike beyond what families can absorb. The weapon is not explosive, it is administrative, and it is extraordinarily effective. I want to talk about the most counterintuitive development of the 2026 insurance crisis. The thing that, when I explain it to homeowners, genuinely shocks them. Because for the past decade, the housing market has been telling you one thing consistently: smart home technology adds value. Connect your HVAC to the internet, install a smart water heater, link your appliances to your phone. It makes your home more efficient, more comfortable, and according to every real estate listing that mentions it, more valuable. In 2026, the insurance industry has arrived at the opposite conclusion. Your smart home is now, in actuarial terms, a liability, and the premium you are paying or will be asked to pay reflects that. Here is the threat model that underwriters are now working from. A networked home appliance is, by definition, a device that can receive commands from the internet. In normal operation, those commands come from you, from the manufacturer's servers, from a utility company's demand response program. But a networked device that can receive commands is also a device that can, under certain conditions, receive commands from someone else. From a piece of malware installed through a compromised update, from a vulnerability in the manufacturer's cloud infrastructure, from a state-sponsored actor that has spent 2 years quietly mapping the attack surface of American residential IoT devices in preparation for a conflict that began on February 28. This is not hypothetical. Since the Iran strikes, U.S. cybersecurity agencies have documented a significant increase in scanning and probing activity, targeting residential smart devices, thermostats, water heaters, HVAC controllers, smart meters. The documented attack scenarios are not subtle. A smart water heater commanded to operate at maximum temperature continuously can fail catastrophically. A smart thermostat commanded to disable heating during a cold snap can freeze pipes in hours. A smart irrigation system commanded to run continuously in a home that's unoccupied can cause flooding that destroys flooring, drywall, and structural elements. Major insurers are now requiring what they call cyber vulnerability assessments for new residential policies in certain markets. An inspector, or increasingly, a digital audit tool, evaluates the number and type of internet-connected devices in the home, assesses the security posture of the home network, and produces a risk score. Homes with extensive smart home integration in high-risk geopolitical zones are receiving premium surcharges that range from 15 to 40% above the base rate. Some are being denied coverage entirely pending a cyber remediation, essentially disconnecting or replacing the smart devices. The homeowner who spent $15,000 upgrading to a fully connected smart home 3 years ago, following every real estate and lifestyle media recommendation, is now being told by their insurance company that those upgrades have made their home harder to insure. The value they added to their property on paper may be offset, or more than offset, by the insurance premium. Increase those upgrades now require. This is the Cyber-Sabotage premium, and it is one of the most direct ways the Iran conflict has reached inside American homes without firing a single shot. The 2008 financial crisis was caused by bad loans, mortgage products that never should have been written, sold to borrowers who could never realistically repay them, packaged into securities that hid the risk until it exploded. The entire system was rotten from the inside. When it collapsed, it took the housing market and most of the global economy with it. The 2026 crisis is structurally different, and in some ways more insidious, because the loans themselves are not bad. The borrowers are not subprime. The problem is not inside the mortgage. The problem is under the mortgage, in the insurance layer that the entire system depends on but rarely thinks about. And when that layer fails, the mortgage system above it fails too. Here is how a housing market dies by insurance attrition. It begins at the margins. Certain zip codes near military installations, major ports, critical infrastructure facilities become classified as elevated geopolitical risk zones. Insurers exit those markets first, or price coverage so high that it effectively prices out mortgage-dependent buyers. When mortgage-dependent buyers disappear from a market, you have essentially removed 85 to 90% of potential buyers. The only people left are cash buyers, and cash buyers do not pay list price when they know they are the only game in town. Home values in these affected zip codes don't just plateau, they drop, and they drop in a way that is sticky. Because once an area develops a reputation for insurance instability, it attracts buyers who will extract maximum value from distressed sellers, which further depresses prices, which further accelerates the exit of owner-occupants, which further reduces the tax base, the school funding, the local business activity, the entire ecosystem of a functioning American neighborhood. For homeowners, the experience is a form of forced wealth confiscation. Your house was worth $380,000 18 months ago. Today you cannot find an insurer willing to write a policy at a premium a mortgage-qualified buyer can absorb. The pool of buyers has collapsed to people paying cash, and the highest cash offer you are receiving is $240,000. You have lost $140,000 in net worth, your retirement, your children's college fund, the equity you spent 20 years building, not because of anything you did, not because of a subprime loan or a bad investment decision, but because a war in the Persian Gulf made your zip code an actuarial problem. Here is the uncomfortable truth at the center of everything we've discussed today. The United States is drifting toward a two-tier system of home ownership, and the dividing line is not income, exactly, it's exposure. Those with a capital to own property free and clear, without a mortgage, without the need for insurance as a lender requirement, can weather the uninsurability crisis. They can self-insure, they can absorb the risk. Everyone else is dependent on a system, the insurance mortgage complex, that is cracking under geopolitical pressure it was never designed to handle, and the political class that could intervene, that could regulate the scope of war exclusion clause expansions, that could fund state fair plan stabilization, that could mandate actuarial transparency for zip code reclassifications. That political class is focused on the war itself, not on the domestic infrastructure the war is quietly dismantling. So what do you actually do? Let me give you 4 concrete actions, not vague suggestions, but specific things you can do in the next 30 days. First, read your policy now, not next month, this week. Find the war exclusion clause. Find any language added in recent renewal cycles about cyber events or infrastructure disruption. If the language has changed since your last renewal and you were not explicitly notified, that is potentially actionable. Document it. Second, request your insurer's written criteria for zip code risk classification. Many states have laws requiring insurers to disclose the factors used in non-renewal decisions. You have a right to know why your zip code was reclassified. That knowledge is leveraged with your insurer, with your state insurance commissioner, and with your elected representatives. Third, contact your state insurance commissioner's office. State insurance regulators have authority over insurer conduct that federal regulators do not. A coordinated flow of constituent complaints about war exclusion clause expansions and zip code non-renewals creates regulatory pressure that individual policyholders alone cannot generate. Your state commissioner is one of the most powerful and least utilized advocates available to homeowners right now. Fourth, understand your mortgage contract's insurance requirements in detail. Know exactly what your lender requires, how long you have to find replacement coverage, and what the forced placement trigger looks like. Knowledge of that timeline is the difference between having 30 days to shop for alternatives and being blindsided by a forced placement notice. The American dream has always been built on the premise that your home is yours, that you earned it, that it is protected, and that no one can take it from you without cause. In 2026, that premise is under attack from a direction no one expected. The weapon is an exclusion clause. The battlefield is your escrow account, and the only defense is information. Here's my ask from you today. Check your insurance renewal notice. If your premium has spiked or you've received a non-renewal, drop your state and the percentage increase in the comments. We are building a real-time map of the uninsurability crisis across America, and your data point is part of the record. Share this video with every homeowner you know, because the only thing more dangerous than this crisis is not knowing it's coming. This is money history. This is money history. We cover the economic stories behind the headlines, the ones that show up in your mailbox before they show up on the news. Subscribe, turn on notifications, and we will see you in the next one.